If you're doing any kind of financial analysis or, just tracking a company you care about, your starting point is always that holy trinity.
Mm-hmm. The income statement, balance sheet, and statement of cash flows.
They are absolutely necessary. They're the headlines.
They are. They're the required starting point, but they are. While they're dramatically insufficient.
Insufficient how?
Think about it. A huge, publicly traded company that operates globally, their entire financial life is often summarized onto, 3 or 4 pages of numbers?
Right. It's incredibly condensed.
They're purely summary reports. They give you the dollar figure, but they offer zero context on how that figure was reached or what potential risks are lurking just, below the surface.
And that context, that essential explanation, the true story of the company's financial health is buried in the financial statement notes.
Exactly. This is the manual, the fine print.
The confession, even.
The difference in sheer volume is often shocking. As you said, the statements are maybe 3 pages. The notes, which are mandatory for transparency, they can easily clock in at 30, 50. I've seen 80 pages of dense text and tables.
And that's not just filler.
Not at all. That's where the real analysis has to begin.
You really can't assess true risk or properly compare two companies without reading those notes. We've seen historical examples like the massive accounting frauds at Enron.
Or the issues that drove the Asian currency crisis, yeah. The systemic problems were just obscured because the necessary detail was either missing or it was intentionally opaque. The notes force management to spell out the assumptions, the estimates, and the critical judgments they made.
So our mission today is to cut through that, 60 pages of density and guide you directly to what you need to know.
We're going to unpack the 4 general types of financial statement notes that are absolutely critical for understanding what you're reading. If you know what each type is designed to do, you know exactly where to look for those hidden truths.
Okay, let's unpack this. Let's start with the first, and I'd say the most fundamental type, the one that answers the question, how did you get this number?
That brings us to type 1, the summary of significant accounting policies. This is the foundation. It basically dictates the entire framework for the numbers. It tells you the specific accounting rules and often discretionary estimates that management chose to use.
And I think the most important thing to get here is that accounting isn't always black and white. It's not like physics where there's only one way to calculate gravity.
That is a perfect analogy. Financial reporting often allows for multiple acceptable and perfectly legal methods to account for the exact same thing.
Which is why this note is so critical if you're trying to make comparisons, right?
Precisely. If you look at Company A and Company B, and they both report, say, the same revenue, but one uses one inventory method and the other uses a different one, their reported net incomes will look completely different.
Even if their operations were identical.
Exactly. So without knowing the policy, you're just comparing apples and oranges. It's a waste of time.
So the note has to explicitly state these choices, like for inventory, as to say if they chose first in, first out FIFO or last in, first out LIFO.
Or maybe the weighted average cost. And those choices have huge implications. If prices are rising, a company using LIFO is going to report higher costs and lower income.
But they'll pay less tax.
Right. A company using FIFO will show a higher income. The note tells you which flavor of reality you are looking at. Same thing with depreciation. They have to tell you if they're using straight line or maybe the declining balance method.
But doesn't that ability to choose a method just open the door for management to, manipulate the numbers to hit some earnings target?
That's the critical tension in accounting. The choice is allowed, but the requirement is that the choice must be disclosed.
And applied consistently.
And applied consistently, yes. The disclosure is the safeguard. And you see this play out in really complex ways, especially with companies that have unique assets.
Tell us more about that Disney example from the sources. That one is fascinating.
It really is. Disney has massive film and television production costs. We're talking hundreds of millions for a single blockbuster.
Okay.
Their policy note explains exactly how they handle those costs. They don't expense them all at once, and they don't just spread them out evenly over 10 years.
So what do?
They expense those costs over the expected product life cycle based on a very specific ratio.
Right.
Current revenue divided by the sum of current and estimated future revenue.
Wow. So that means If management is really aggressive in their estimate of how a movie will do,
Right.
let's say they think the new Star Wars film will make twice as much as analysts predict.
Then they get to report lower current expenses, which of course artificially inflates their current reported income.
And the note forces them to state that.
Exactly. The note forces them to state that specific ratio method. It gives you, the analyst, the insight to say, okay, their profit this year is highly dependent on an internal, unverifiable estimate of future box office success. Without that policy note, you would never know the mechanism driving that number.
That's a perfect illustration. So once we know how they calculated the numbers, we move to type 2, which helps us understand the numbers themselves.
Right.
The primary statements are aggregates. They give you one single enormous number for long-term debt. This is where we drill down.
This is type 2, additional information about summary totals. The whole purpose here is context, to break down that one big number into its meaningful parts. It lets you assess the composition and, frankly, the quality of that number.
Okay, let's use the Safeway example. Their balance sheet shows a single line for long-term debt, $5.244 billion. It's just a number.
But the note unpacks it. It shows you that the $5.244 billion is actually a complex mix of things. It's got commercial bank loans, mortgages tied to specific properties, debentures,
Which are unsecured bonds.
unsecured bonds, and maybe even loans in different foreign currencies.
So as an investor, why do I care if it's a debenture versus a mortgage or a loan in euros versus dollars?
Because that distinction is all about risk and maturity. If it's a mortgage, you know specific real estate is pledged as collateral. If it's a debenture, it's unsecured, which is riskier if the company defaults. If the debt is in euros, the company now has currency fluctuation risk. And the note also provides a maturity schedule. It shows you exactly when those individual pieces come due. That's essential for assessing their liquidity risk over the next 5 years.
You would never get that from the main balance sheet. And we see this on the asset side too, right? The Bank of America example is a great case study for understanding the quality of an asset.
Absolutely. A bank's balance sheet might show a massive total, say, $947 billion in gross receivables. That number sounds impressive, but without the note, you have no idea how much of that the bank actually expects to collect.
Right.
The note specifies the critical counter figure, the allowance for doubtful accounts. In this case, say, $9.6 billion.
That $9.6 billion is the ultimate context. It is management's best guess, their judgment, on the loans that will go bad.
And it tells you so much about their customer base and their credit standards.
And that judgment is key. If the bank lowballs that allowance, their assets look stronger today, but they're facing a huge write-down later if those customers actually default.
And the note lets you gauge if management is being prudent or maybe a little too optimistic. We see the same concept with inventory. Analysts are never satisfied just knowing the total inventory value.
Because it could be finished goods, ready to ship, or it could just be a pile of raw materials in a warehouse.
Exactly. The notes will break inventory down into raw materials, work in process, and finished goods. If that work in process number is spiking, maybe there's a bottleneck in production. If finished goods is spiking, maybe sales are slowing down. It's all about how quickly those assets can turn into cash.
So if type 1 is the how and type 2 is the composition, then type 3 is maybe the most critical for risk assessment. It deals with stuff the company knows is important, but they can't actually assign a dollar value to it.
Yes. This is the disclosure of information not recognized. And it all hinges on a really key distinction in accounting.
Which is?
Recognition versus disclosure. Recognition means you have enough certainty to summarize an item into a single number and put it right on the financial statement. A confirmed liability, for instance.
By disclosure.
Disclosure means the information is absolutely critical for you to know, but it's too uncertain or contingent to be boiled down into a single number. So it's communicated only in the notes as text. It's the uncertainty factor.
So if I can't quantify the exact loss, I can't recognize it as a liability, but I definitely can't hide the risk either.
That's the rule. And the perfect and honestly terrifying example of this is Altria.
The tobacco company.
Right. Their notes contain extensive disclosures detailing literally thousands of ongoing lawsuits alleging massive damages.
Thousands. And the potential financial hit is astronomical, billions and billions of dollars. But we don't see a lawsuit liability line item on their balance sheet.
No, because the ultimate outcome, the probability of loss and the exact amount of that loss is still too uncertain. They can't record a specific number, but they are absolutely required to communicate the full scope of that threat in the notes. Without reading that section, you would fundamentally misunderstand the existential risk facing the company.
What's wild is that the uncertainty actually protects the balance sheet for now. If that liability were certain, they'd have to subtract billions from their assets. It could sink their equity.
It could lead to insolvency, yeah. You also see this type of note for things like pension obligations, environmental cleanup liabilities, or even the estimated value of oil and gas reserves for a company like ExxonMobil.
Right. The reserves are critical to their future, but not yet a precise, recognized asset.
So they're disclosed in the narrative. It's the required story of risk and potential value that hasn't fully materialized yet.
Which brings us to our final category. This one is sort of the catch-all for regulatory must-haves. Tech 4. Supplementary information required by FASB or the SEC.
Correct. The regulators, the Financial Accounting Standards Board, and the Securities and Exchange Commission mandate certain extra disclosures to give everyone a complete picture, even if it doesn't fit neatly into the other three types.
And what's great is that this forces disclosure on parts of the business that management might otherwise want to keep, bundled up and hidden. What are some of the common ones here?
Two of the biggest are the required disclosure of quarterly financial results, so you get more frequent data and information about the performance of different business segments. Segment reporting is invaluable.
Segment reporting. So I can see how different product lines or geographic regions are doing.
Exactly. A huge conglomerate might be performing well overall, but the note could reveal that one specific division is just bleeding money. That's critical information for an investment decision.
So back to the Safeway example.
Yep, their notes included the disclosure that 15.1% of its total sales were generated specifically in Canada.
And that's useful because
it tells you exactly how much their performance is subject to Canadian economic risks, currency risks, regulatory risks, all of which might be very different from the U.S. market.
So to bring this all together for our listeners, we've got 4 distinct functions here. Type 1, the policies note, gives us the how.
The methods and assumptions they use to calculate everything.
Type 2, additional info on totals, gives us the composition.
The details that make up the big numbers, like the different types of debt or inventory.
Then Type 3, disclosure of information not recognized, gives us the uncertainties.
The lawsuits, the risks, the things that are too uncertain to quantify but too important to hide.
And finally, Type 4, supplementary info, provides all the mandatory regulatory details and breakdowns.
And that's it. These notes are where the rubber meets the road. They are the essential foundation for any real analysis, ensuring you aren't misled by just the top-line numbers.
Reading just the 3 primary statements is like reading the back of the book summary of a really complex political drama.
I like that.
The notes are the entire manuscript. You get the subplots, the critical details, and every potential conflict. Knowing these 4 types lets you make much, much better informed decisions.
And here's a final thought for you to mull over as you go look for the real story behind the numbers.
Okay.
If the disclosure of ongoing lawsuits, like Altria's, is critical for understanding a company's risk today, consider what happens to that company's entire financial health and its stock price. The very moment that uncertain disclosed liability suddenly becomes a certain recognized financial number on the balance sheet.
Because of a court ruling or a settlement.
Exactly. That sudden, often devastating shift in classification is precisely why ignoring the notes means you're gambling with incomplete information.